Hello friends, today we are going to study one of the most fundamental pillars of government financial administration, the General Financial Rules 2017, issued by the Ministry of Finance, Department of Expenditure. In this section we will focus on Rule 1 to 6. These rules may appear simple, but they form the foundation of the entire financial framework of the Government of India. Before entering into Rule 1 to Rule 6, let us understand what GFR 2017 actually is. The General Financial Rules are a compilation of rules and orders of the Government of India, to be followed by all ministries and departments while dealing with public money. It ensures financial discipline, transparency, accountability and proper utilization of public funds. Remember, whenever public money is involved, GFR applies. For officers in Indian Railways and other departments, understanding GFR is not optional, it is mandatory. Rule 1 states, these rules may be called the General Financial Rules 2017. This simply establishes the official name of the rule book. Earlier we had GFR 2005. In 2017, it was revised and updated to modernize procurement procedures, e-procurement, transparency norms, and financial delegation. So, whenever you refer in file noting, audit reply, or examination answer, we must write as per GFR 2017. Rule 1 Commencement. The rule clearly says these rules shall come into force at once. This means the rules became effective immediately upon notification in 2017. No waiting period and no phased implementation. This ensures uniformity across all departments. Applicability of GFR 2017. Now comes a very important part, applicability. GFR 2017 applies to all central government ministries, all departments, attached officers, subordinate officers, and it also applies to autonomous bodies. However, there is one exception. If an autonomous body has separate financial rules approved by the government, then those rules will be applied instead. Rule 2 Definitions. Now we move to Rule 2. Rule 2 defines important financial terms used throughout GFR. Why are definitions important? Because in financial matters, interpretation must be precise. Even one word can change authority, responsibility or liability. In promotion exams and interviews, definitions are often asked directly. First definition, accounts officer. An accounts officer means head of an office of accounts, head of pay and accounts office under departmentalization scheme. This officer ensures bills are correctly passed, expenditure is booked properly, and accounts are maintained. Audit officer, head of an office of audit. Now, who is the highest audit authority? that is the Comptroller and Auditor General of India, or CAG. The CAG audits government receipts, government expenditure, and public sector undertakings. Audit is independent of executive control. Constitutional funds. Now let us understand financial funds. Consolidated Fund of India. As per Article 266(1) of the Constitution of India, all tax revenue, non-tax revenues, and loan raised are credited to the consolidated fund. No money can withdraw from this fund without parliamentary approval. Contingency Fund of India. This is for urgent, unforeseen expenditure. For example, natural disasters requiring immediate funds. It is later recouped from the consolidated fund. Government account. Government account includes consolidated fund, contingency fund, and public account. The term is important in budget and account discussions. Competent authority and controlling officer. Competent authority means the president or authority whom power is delegated under GFR, delegation of financial power rules, or special government orders. In practical terms, not everyone can sanction expenditure. Only the competent authority can. Controlling officer. This officer controls expenditure and revenue collection. In many departments, head of the department acts as controlling officer. They are responsible for ensuring budget is not exceeded, funds are properly utilized. Administrator and department. Administrator is a union territory by whatever name called. Department of Government of India means ministries, departments, secretariats, officers listed in allocation of business rules. This ensures clarity to whom is part of central government. Drawing and Disbursing Officer, DOO. One of the most important operational authorities, Drawing and Disbursing Officer, DOO, usually Head of Office and Gazetted Officer. The main responsibilities of DDO is draw salary bills, draw contingent bills, make payments, and ensure correctness of claims. DDO is financially accountable. In practical life, DDO errors can lead to audit objections. Financial year and government. Financial year 1st April to 31 March. Why it is important? Because budget is prepared annually. Appropriation lapse on 31 March unless otherwise provided. Government. Government means central government, not state government, not PSU, not private body. This clearly avoids legal confusion. Head of department and head office. Head of department or HOD must not be below rank of deputy secretary declared by concerned department and exercises delegated financial powers. Head of office. Head of office is a gazetted officer declared under delegation of financial powers rules. In field formations, this authority is very significant. local body and a local fund. A local body means an authority legally entitled or especially empowered by government to administer a local fund. Example include municipal corporations, panchayat, development authorities. These bodies are not central government departments, but they administer public funds and therefore are subject to financial oversight. Local fund. A local fund is defined under treasury rules. It refers to funds administered by local authorities for public purposes. Even though managed locally, these funds remain subject to financial discipline, audit control and regulatory oversight. This ensures accountability even at decentralized levels. Recurring or non-recurring expenditure. Understanding this distinction is extremely important in budgeting. Recurring expenditure is incurred periodically for same purpose. Example, salaries, rent, electricity charge, or annual maintenance contracts. These expenditures occur regularly and must be provided for in every annual budget. Non-recurring expenditure. Non-recurring expenditure is one-time expenditure. For example, purchase of machineries, construction of a building, procurement of new equipment. This distinction is important because budget classification differs, financial approvals may differ, capital and revenue heads may differ. President and subordinate authority. President. Under GFR, President means the President of India. However, practically financial powers of the President are exercised through delegated authorities under rules. This shows that all executive power flows constitutionally from the President but exercised through authorized officers. Subordinate authority. Subordinate authority means any department of central government or any authority subordinate to the President. This clarifies the administrative hierarchy in financial matters. Public account and primary unit of appropriation. Public account is defined under Article 266(2) of the Constitution of India. It includes Provident Fund, small savings, deposits, and other trust type funds. Unlike the consolidated fund, no parliamentary vote is required for withdrawal. However, accountability still exists. Primary unit of appropriation. This is very important budget concept. It refers to the basic unit under which expenditure is authorized in the budget. In simple terms, it is the smallest unit of financial control under a particular head. All expenditure must remain within its primary unit of appropriation. Reappropriation. Reappropriation means transfer of funds from one primary unit of appropriation to another primary unit. Important points. Total grant cannot be exceeded. Approval of competent authority is required. New services cannot be created through reappropriation without proper approval. This concept ensures flexibility without violating parliamentary control. Public works. Public works includes civil works, electrical works, public buildings, infrastructure projects, or original works and repair works. Examples include government offices, railway buildings, bridges, or signaling infrastructure. This definition is broad and includes all infrastructure for public use. Understanding this is crucial in work-related financial sanctions. Treasury rules and Reserve Bank. Treasury rules govern custody of government money, withdrawal procedures, accounting procedures. They ensure safe handling of public funds. Reserve Bank. Reserve Bank means Reserve Bank of India. It includes RBI officers and banks acting as RBI agents. RBI handles government receipts, government payments, and public debt management. In financial administration, RBI acts as banker to the government. CAPEX Model. Now we come to modern procurement models. CAPEX Model, Capital Expenditure Model. In this model, buyer purchases asset outright. Buyer owns the asset. Buyer arranges maintenance after warranty. Consumables are procured separately. Asset is disposed of after useful life. Its features: high upfront cost, ownership risk with buyer. Example, railways purchasing signaling equipment directly. OPEX Model, Operational Expenditure Model. In this model, seller provides goods, seller maintains equipment, seller supplies consumables, and seller may take back asset after contract life. Buyer pays periodic payments as per contract. Its features: lower initial investment, service-based arrangement, risk partly transferred to vendor. This model is increasingly used in IT systems and modern infrastructure. Interdepartmental consultation. Rule 3 ensures administrative coordination. If a case concerns more than one department, no order shall be issued until all departments concur. If concurrence is not achieved, decision must be taken by or under the authority of the cabinet. Important clarification: even if one department's decision affects another, it is treated as interdepartmental. This prevents administrative conflict, policy inconsistency, and financial overlap. Rule 4. Departmental regulations. Financial character. Any departmental regulation that has financial implications or has important financial bearing must be made by Ministry of Finance or approved by Ministry of Finance. This ensures uniform financial control across government. Departments cannot independently create financial rules without MOF approval. Rule 5. Removal of doubts. If doubt arises in interpretation of GFR, matter must be referred to Ministry of Finance. This ensures uniform interpretation nationwide, avoidance of conflicting decisions, and legal clarity. Ministry of Finance is final authority on interpretation. Rule 6. Modifications. Rule 6.1. Ministry of Finance may issue general instructions or special instructions. These instructions may modify procedures. Rule 6.2. Any other authority cannot modify GFR system unless express approval of Ministry of Finance is obtained. This safeguards central financial discipline and uniform application of rules. Okay, thank you.